Ask Abby, providing answers, insights, and education designed to give you the tools and knowledge you need to thrive financially and live confidently in retirement.
And welcome into Ask Abby with Abby Reed, co-CEO of the Reed Financial Group, the retirement family, your resource for a common sense approach to planning and great information on your investments and your retirement progress. Abby, we get questions submitted to the website, goaskabby.com. And one recently asked about the common planning mistakes that you have seen. What are some of the most common planning mistakes that you have seen? And appropriately, you've got a resource on that. 7 financial myths, some common planning mistakes and misconceptions to reconsider. And I'm certain that some of the most common mistakes that you've seen are included on this list.
Yes, definitely. So we have the 7 most common financial myths. What we find most often is a lot of people are making decisions based on incorrect information, misconceptions, or even myths about how the market works, how retirement works, especially. So a lot of the education and the information that is most popular and that's most available is really about the accumulation phase, which is great that there's information out there that's readily available. But as we start to transition from the accumulation to the preservation and distribution phase, those same rules and that same information don't really apply anymore. And so that a paradigm shift has to really happen when you start planning for retirement or getting into that retirement red zone, as we call it. So what we'll do today is go over number 1 and number 2 on our list of the 7 financial myths. The first one being that the market always goes up. So what we hear a lot of is in times like this, it's okay. The market comes back. It always comes back. Over time, the market always goes up. And I understand why people say that and recite that and tell themselves that, because right now is a very disconcerting time and a lot of people are anxious. And so we understand why people, have that
trying to convince ourselves it'll all be okay.
Yes, exactly. So what we like to educate people on is that while, over say 20 years, 30 years, 40 years, most likely there's going to be a positive gain in the market. There are periods of time where the market might be even flat. So like, for example, the lost decade, where investors, for the risk that they were taking, didn't really get any reward, at all. It was really sideways. We've had situations where 3 years in a row, the market has gone down. And while that's very uncomfortable and not fun to experience when you're in the accumulation phase, if you still have time, you're still adding to your investments, that can actually be an opportunity. So you're buying those shares or the stocks, whatever you're investing in, you're buying those at a lower value. But when you're transitioning to retirement, there's something called sequence of returns risk. There's lower capacity for risk taking, and there's less time to be able to make up those losses. And so that's what we really have to be careful about. And I think most people kind of intuitively know or have learned that the closer you are to retirement, the older you are, the less risk you're supposed to take. But I don't think a lot of people understand why you need to take less risk. And that's the most important part.
You don't have the time to allow for the market to come back in some cases, especially if we are liquidating assets and withdrawing income from our investments. Those dollars aren't there in the market for it eventually to come back.
Right, exactly. So sequence of returns risk is something that we do a lot of education on because most people have never heard of it before, and don't necessarily understand the math. And so we'll definitely touch on that today. But something else to talk about a little bit is just making sure that you have a strategy that is flexible, disciplined, but flexible. So from 2000 to 2012, where basically the major stock indexes were sideways, there were other opportunities during that time. So just having resources, like Reed Financial Group, Brookstone as our back office, as our investment committee, that's taking a look at that. That's that active management, because stocks aren't necessarily always going to be the only answer. So we've got to have opportunities for, safe and secure options as we get closer to retirement. So what are the options that are available out there, depending on your liquidity needs, depending on your income needs. So just making sure that you have a flexible approach so that when these things happen, like in 2022, when we saw those all indexes go down, even bonds, I mean, there's been 2 instances since I think it was World War II, I want to say, where stocks and bonds were both down for the entire year. And one of them was in 2022. So what I also like to explain to people is, just because it hasn't happened before or it's not happened very often does not mean that it's not going to happen in the future, especially because with the markets, I was talking to somebody about this yesterday. It used to be a lot slower. So if you wanted to submit a trade, it was a little bit of a slower process, but now everything is electronic. So say a certain index or a certain stock hits a price, these automatic stop loss orders go through and it can tank a stock or an index, with lightning speed. And that's something that we have not really had to deal with in the past. And that's something that is important to understand.
Don't have to wait for the paper to be printed and then end up on our front stoop to know what the stock movement was the day before any longer. It's all instantaneous. And Abby, our outcome is only as good as the tools that we're utilizing and the assumptions that our plan is based on. And a lot of people's plans, kind of using air quotes there, projections, unfortunately, are based on an assumption that the market is always going to go up. And so I think when the projection is based on that premise, and then we have a year like 2022, it can be all that much more unsettling. And I'm sure you're seeing a lot of that here as we're flipping hopefully past some of the market volatility, at least past the calendar year 2022, and trying to sort of regroup and reformulate plans.
Right. So a lot of people are asking maybe that hadn't taken those steps yet to shift from the accumulation phase to the preservation distribution phase in retirement. What can I do now? Because I never want to go through 2022 again. And we saw the exact same thing in the financial crisis when the markets went down at a certain point over 50%. It ended up for the year being a loss of over 30%. But what we saw over and over again is people coming in and saying, I never want to go through that again. But what happens over time, the markets have a run, as they typically do. And the frame of reference, our memories get kind of short. And we forget that these things can and will happen. And so right now is a really good time for people that are thinking, what can I do now to better protect myself? I don't want to make the same mistakes that I did in 2022. What can I do now to position myself so that when we go through another situation like this, I don't have to worry as much. I know that my plan is still solid, but I'm not having to stick everything under the mattress, because as we saw last year, it was a double whammy. It was markets were down, stocks and bonds, and inflation was through the roof. So sitting in cash, while you weren't losing because of the market, you were losing purchasing power. So it was kind of like a where do I go for a lot of people. And that's why it's important to work with an advisor and a company that has a full tool belt of tools. And our partnership with Brookstone is invaluable for that. So they really have a broad range of solutions. They're constantly, as we are looking at, what's going on out there, what's taking a proactive approach, and they help us to be able to actively manage our portfolios and really concentrate on managing that downside, because we know that, the markets will come back eventually. Who knows when? We could have 3 down years. Again, who knows, but making sure to mitigate that downside is so much more important than a lot of people realize. It's not just about, earning 20+% in 2021. It's about what did your portfolio do in 2022? That's what I want to know, because it is a lot harder to make up losses than people really think. So for example, if you lose 50%, you don't have to make 50% to get back. You have to make 100% to get back. And so focusing on that drawdown protection and that downside risk management is really important. And a lot of people don't understand or even know all of the options that are out there right now. And as interest rates have gone back up for the first time in a long time, those safer options are now much more valuable. And it's a really good time to take a look at that. Take a look at your bond portfolio, the bond portion of your portfolio, and make sure that that's where it's supposed to be, as well as the risk portion, the stock, the equities, those type things.
Yeah, interest rates becoming much more attractive. And of course, they've got all the tools to help you plan there at Reed Financial Group, the retirement family. Your explanation there, Abby, of the loss and the gain that's required to just get back to break even kind of segues very nicely into myth number 2 on your list of the top 7 financial myths, which is the average rate of return. Not only are a lot of people sort of planning on the market always going up, but they're also planning on a specific rate. And oftentimes we sort of get allured into a high rate of return that's being advertised on a specific fund that might in actuality not be what the real world results would have been had we been invested in that fund. Can you sort of explain the difference there between those advertised past 3 years rates of return versus what actually happens with our money when we're invested?
Yep. So I think that's a great point. So the average rate of return that's on most statements, whether it's a specific mutual fund or your 401k or, really any type of investment, is not necessarily going to translate into what I earn as far as my dollars go. So something could advertise, we've had a 10% average rate of return for the past 10 years. But what we know about large losses is that you can have technically have a 10, even a 20% average rate of return, and you could end up in the exact same spot as far as dollar amount that you were when you started.
Yeah.
So
you've got
that
an
doesn't
example.
Necessarily. Yep.
You've got an example on the 7 myths. You start with 100,000, you get a 60% rate of return, and then a negative 50% rate of return, and then a 20% rate of return. So positive 60 minus 50 plus 20, that's a 30% or 30 cumulative, divide by 3 because it's the 3 years, and you actually end up with less than you start with. It's an average 10% rate of return. You break down the math, and that was really kind of eye-opening to look at there.
Right. So you start with 100,000, you earn a average rate of return of 10% over those 3 years. And then you look at your statement and it's 96,000. It's like, wait a second, how did I lose money, but my average rate of return is 10%. And that's that large loss, that 50% loss that's what's eating into the actual dollar returns. And so there are a lot of different ways to calculate actual returns. So it depends on what type of metric that fund is using. And we don't have to get into all of that because that can be kind of boring. But the most important thing for people to remember is that average rate of return, while it's important, it's not the only thing that's important. So what we look at, go ahead.
And as you and I were talking about before the program, Abby, the actual real rate of return of the market is in many cases significantly lower than people think it is or expect or anticipate it to be.
One of the most common myths that we hear is the the idea that the S&P 500 is going to, over a long period of time, or maybe 5-10 years, is going to average 10%. It's kind of like set in stone in some people's mind. It's the benchmark that they use a lot of times. So they'll evaluate how their investment is doing or their advisor is doing. And, if it's not averaging 10%, then they might not be so happy. But what they don't realize is, depending on the time frame that they're looking at, that's going to deviate significantly. So what we were just talking about before we started today was from 2000 to 2022, the average return for the S&P 500 was much, much lower than 10%. And that's 22 years. That's quite a bit of time. And that might not be a full retirement, but that's a good chunk. 20 to 30 years is what we kind of typically expect for a retirement. So if you've done a retirement plan or, an income plan, and you're banking on 10% returns over the 20 to 30 years, you could fall significantly short of that. And then something else that we were talking about is the Dalbar study that comes out every year. They haven't released it for 2022. I'm really curious to see what it'll say about that. But for 2021, which was a stellar year for stocks, across the board, you could throw a dart and you would do pretty well. The average investor underperformed the S&P 500 by over 10%. So the S&P 500 2021 was up over 28%. The average investor, 18%. So while 18% is obviously still good, that's still a huge underperformance. And so when we're looking at index returns, the S&P 500, those are not actual investor returns. Those are not real world. That's a synthetic index that, sure, you could buy and hold that, but there's things that come up. So timing, when your money goes in, when your money comes out. And then there's the behavioral stuff that we have to think about. So a lot of people, they think that they can take and they can accept the risk of the S&P 500 because it's the kind of the benchmark, the standard index that a lot of people are invested in. But what they don't necessarily think about until it happens is those huge drawdowns. So sometimes over 50%, over 20% on a regular basis. And so what people will do is they might panic a little bit and take some out at the wrong time. And that can really affect the overall long-term returns. And that's why the average investor is typically underperforming indexes by quite a bit.
Human nature and emotional reaction when investing, they do not often mix nor lead to optimal results. And we've talked before about the impact of emotional investing, and that's another factor that Dalbar study continually looks at over the course of time. They've often shown that emotional factor leads to even poorer results for investors. But several great examples, several things that were really eye-opening, Abby, on this list of the 7 financial myths. And I know that this is something that if anybody is interested in looking into more of these to see if their plan and ladies and gentlemen, your financial future is reliant on any of these myths or misconceptions or outdated assumptions, then pick up the phone, give a call to the team from Reed Financial Group, or you can go online, goaskabby.com, goaskabby.com, or 678-442-0255, 678-442-0255 to reach the retirement family there at Reed Financial Group. And Abby, I think a few more of these probably appropriate to cover into some future episodes because we get a lot of questions on several of these.
Absolutely. There's a lot of them out there, and the top ones are certainly on this list. So we'll go into some more detail in the next several episodes.
Always a pleasure, Abby.
Thanks, Peter.
Here to answer your financial questions, visit the website goaskabby.com for show resources and to submit your questions and get answers, or to schedule your complimentary financial investment and retirement planning strategy session. You can also reach out to Abby directly at 678-442-0255. That's 678-442-0255, or at goaskabby.com.
Investment advisory services offered through Brookstone Capital Management, LLC, BCM, a registered investment advisor. BCM and REIT Financial Group are independent of each other. Insurance products and services are not offered through BCM, but are offered and sold through individually licensed and appointed agents. Third-party ratings and recognitions are no guarantee of future investment success and do not ensure that a client or prospective client will experience a higher level of performance or results. These ratings should not be construed as an endorsement of the advisor by any client, nor are they representative of any one client's evaluation.